Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets. We are going to cover it all. In today's episode, we're going to start with a quick fire round of news because there's a number of headlines we want to cover. Then we are going to answer a community question on the valuations of Aussie tech stocks.
Yep.
And we're going to close out with our explainer of Australia's proposed superannuation tax. And I've made Bryce promise not to get too political.
No, I made you promise. But let's get into it.
News and markets.
Headlines we're going to cover today: uranium stocks, Tesla versus BYD, WiseTech's largest acquisition, and then Donald Trump is buying crypto.
Yes, so let's start with uranium stocks ripping. And this started last week when President Trump over in the US signed an executive order intended to accelerate the expansion of nuclear energy in America.
Yep.
Unsurprisingly, nuclear stocks ripped.
Yes.
So there are three big uranium miners in Australia that tell the story. So I hope you were buying uranium because what did they do?
Well, I should have kept my eye on this for the 500 to 5,000, but yes, the three big ones. So Boss Energy, it was up 22% in the first 2 days preceding the announcement. Deep Yellow up 23% and Paladin Energy up 15%.
Yes. Now, it's easy to be excited. It is important to zoom out. Over the past 12 months, all of those stocks are actually still down.
Yes.
Boss Energy and Paladin down about 20%. Deep Yellow down about 14%. But there's no doubt nuclear is a hot commodity, a hot topic, and therefore uranium is a hot commodity at the moment. We've also seen in Australia, nuclear continues to be a sticking point between the Liberals and the Nationals.
Big time.
It seems like their compromise position is not putting government money towards nuclear energy, but lifting the ban on investment in nuclear energy.
Not bad.
If we see the US continue to accelerate, it will be one to watch how that affects discussions here in Australia. Obviously, the big driver of a lot of this is AI.
Yeah.
Because the increasing demands for energy and then clean energy coming from AI seems to only be going in one direction.
Yeah.
And nuclear is seen as like a clean baseload source of power.
Let's turn to Tesla and BYD. Ren, earlier this year we covered the story that BYD, which is Build Your Dreams, the EV manufacturer from China, they outsold Tesla here in Australia for the first time, and that trend is now continuing over in Europe. BYD is eating Tesla's lunch.
Eating Tesla's lunch, is that how we're describing it?
Well, it feels like it.
So for the last month, for the first time ever, BYD beat Tesla in Europe. Tesla sold 7,165 vehicles, while BYD sold 7,231.
Yeah.
And this is significant because much like the story was in Australia earlier this year, it's the same in Europe. Tesla has long been the market leader, and now they are getting disrupted. Particularly notable, BYD is a pretty new entrant in Europe. Before 2022, it only had operations in Norway and the Netherlands. No idea why those two countries. But, it's only been selling across Europe for a couple of years. And now it is outselling Tesla. So that is one to watch. Simon, or Mr. Beat Up, our resident Tesla bull, said to me as I was walking up to the studio today, don't sleep on Tesla's robo-taxi event in Austin coming later this year. So that's what the Tesla bulls will be watching.
Yeah,
the rollout
time
of fully self-driving.
And Musk has announced he's back to sleeping on the floor of the Tesla office now that he's taken a step back from the White House, focusing back on Tesla and his XAI and X.
Yes.
As well. So Anyway, we'll keep moving. WiseTech, one of the largest software companies here in Australia, a logistics software company. They've made their largest acquisition to date, spending $3.25 billion to buy Texas-based software company E2 Open.
Yeah. Now, for people who are unfamiliar with WiseTech, their sort of seminal platform is CargoWise, and it helps companies that are involved in shipping goods internationally, like getting through customs and all of that stuff. The patchwork of regulatory agencies and companies that are involved in that is difficult, and their software has sort of streamlined a lot of those processes. And their history, so they've been in operation for 30 years, and they have a history of buying smaller logistics software companies, bolting that functionality onto their CargoWise platform, and it's been incredibly successful. This one is really interesting because this is their largest acquisition to date, and it comes after 6 months of turmoil for the company,
at least.
Around founder Richard White's personal conduct. A number of board members left, but he has kind of reestablished himself in control of the company.
Yeah.
And now they are making this large acquisition. I guess the first thing to note is the market liked it. The stock was up almost 5% the day the acquisition was announced. But this will be an interesting one to watch.
Absolutely. And then to close out our headlines, a bit of a what the. Trump Media and Technology Group, the ticker is TMTG, a group controlled by Trump's family and the group behind his Truth Social app, which he now uses instead of X. They plan to raise $3 billion US dollars or 4.6 billion Aussie to go out and buy cryptocurrencies such as Bitcoin.
Yeah. Now, this was broken by the Financial Times.
It's unbelievable.
Trump Media and Technology Group obviously didn't supply the Financial Times with the story because this was the part that had us saying, what the? Well, I mean, the whole story did, but this in particular. Here was TMTG's statement to in response to the Financial Times article. Quote, apparently the Financial Times has dumb writers listening to an even dumber source.
He loves that word, doesn't he?
Well, I don't think that was from Trump, but it's just like there's a certain level of decorum that has exited the building.
Yes.
They expect, so the Financial Times has reported that the expectations are TMTG will announce this $3 billion crypto buying plan at a big crypto convention in Las Vegas where some of the speakers include US Vice President J.D. Vance, Trump's crypto czar, David Sachs, and then Trump's kids, Donald Trump Jr., and Eric Trump.
Unbelievable.
Yes, the mixing of official business and personal business is something that...
It's out of control.
I was going to say something like it should be watched, but
it's out of control.
As we're learning in this episode, Bryce is the political one and I am the sober middle ground. So look, that is the news. If you want to keep up to date with what's happening, what's moving markets and what companies we have our eye on, make sure you sign up to the Equity Mates Daily newsletter. All the news you need to know delivered to your inbox 6 a.m. every weekday morning.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question. Your
Answer.
We love getting questions from our community, and today's comes from Arjun.
Hey guys, I've noticed that Australian tech stocks often trade at quite a significant premium. So for example, I bought Megaport and it's almost doubled since then, which is great. But it is now trading at quite a high forward P of around 80. My question isn't just about Megaport, but about the Aussie tech stocks market in general. So given the scarcity of high quality tech companies on the ASX, how should investors assess when to trim or sell their positions? Thank you and love your work.
Thanks, Arjun. We love hearing from our community members. If you'd like to ask a question just like Arjun did, you can head to the link in the show notes or description below and leave us a voicemail. But Ren, great question. He's not wrong.
He's not wrong.
Aussie stocks do seem to trade at pretty decent premiums.
Well, to be clear, Australian technology stocks. Well, actually, to be fair, also Australian banks. But yeah, so we've had a look at ATEC, the Beta Shares Australian Technology ETF, and we've just taken a look at the top holdings in that ETF and their price to earnings ratios. So as I walk down the list, WiseTech, 111 PE, Xero, 133, Pro Medicus, 293, Computershare, 28, reasonable in comparison. Car sales, 53. So that's the top 5 of that ETF. As you work down the list, these companies are also in the top 10. Technology One trading at 95 price to earnings. How about this? Life 360 trading at a 590 price to earnings ratio. So there's no doubt that Australian tech companies can trade at eye-wateringly high valuations.
Yes.
So let's compare it to the top 5 in a US tech ETF, which is some of the biggest technology names that we know.
Yep.
Microsoft trades at a 35 price to earnings, Nvidia 45, Apple 30, Amazon 33, Alphabet 19. So if we just pause there and we say the top 5 big US tech stocks, none of them trade above a 50 price to earnings, whereas 4 of the 5 largest tech stocks in that Australian technology ETF trade above 50. 3 of the 5 trade above 100.
You could argue, though, that it might be a bit of an unfair comparison.
Okay, well, why is that?
I guess because some of those massive ones that you've spoken about there, they might not necessarily have the same, I guess, growth prospects as some of the ones that you've spoken about, some of the smaller tech names.
Yeah, now that is a fair point. I would maybe argue the toss on that with a company like Nvidia.
Yes.
But I think there's no doubt that Alphabet, Apple, Microsoft has seen a slower growing. So let's have a look at some of the, I guess, call it more hyped tech US tech names. I just pulled a couple of examples out, but we can find others if you think I've missed any. Spotify trades at 104 price to earnings. Shopify trades at 82 price to earnings. AMD trades at 81 price to earnings. And the biggest whopper of them all, in every sense of the word, in my opinion, Palantir trades at a 539 price to earnings.
And just for anyone listening, what that means is essentially if you're buying it today, you're effectively paying $539 for every dollar that they make.
Every dollar of profit.
Every dollar of profit.
So for Alphabet, you're paying $19 for every $1 of profit.
Yeah.
Whereas for Palantir, you're paying $539 for every $1 of profit.
Whopping.
Yeah. So I think the takeaway is that some of the Aussie tech names trade at a premium, but not at a crazy premium compared to the most hyped US tech names.
Yes.
So I think we can say at this point that Aussie tech stocks do trade at a premium because we didn't pick the most hyped Aussie tech names. We just picked the biggest.
Tech, yeah.
Although some of them are the most hyped. Yeah, like they trade at the same levels that the most hyped US names that like the whole world is looking at trade at.
Yeah.
So I guess the question is, why do these Aussie tech stocks trade at a premium?
I mean, I'm even thinking some of the companies that, like net worth even 74.
Yeah.
Yeah. So why? The question is why? Well, the market here, there's not as much opportunity over here as there is in the States. More investors are looking for good quality tech companies, but there's less to choose from. So I guess increased demand obviously leads to pushing up valuations. Smaller market, so it's less competitive in terms of the companies that are listed on the stock exchange.
So that is the main reason that's given. And, we think about our opportunity set that we can invest just as easily in Australia or America. But if you think about a lot of the institutions or the fund managers that have mandates to invest in Australia, then they have to pick from the list of Aussie names.
Yeah.
So that's why scarcity of opportunity sometimes leads to higher valuations for those opportunities that are available. There are some other reasons that are given that I find less compelling. Some people argue that a smaller market like Australia means there's less competition in the tech space, so they can then they can charge more and get higher margins and become more profitable. I don't think that actually plays out, but anyway, that is an argument. Category winners in Australia can sometimes become global players because they have this like solid base in Australia. I would say WiseTech is a category winner globally.
Yeah.
I think some of these arguments fall down on the globalized nature of technology these days. Small market, it's like we have American companies competing against Australian companies in Australia. Anyway, there's also an argument that there's less short selling in Australia, so the price discovery mechanism isn't as strong. Again, I don't think it's a compelling argument, but it is an argument that is sometimes given. But if we just take it back to like what we need to think about as investors, there is a certain irony in the fact that Aussie tech stocks do sometimes trade at a premium when they're serving a smaller market in general. They have lower margins, again, in general, and
slower growing,
again, in general. So how do we approach it as investors? And importantly, as Australian investors that can just as easily invest in America as Australia?
Well, I think that's the point. If you're looking for high growth tech companies, don't just think that your opportunity set is Australia. I mean, we are somewhat limited by the exchanges that we can trade on or invest through, but there's plenty of opportunity outside Australia. So be country agnostic and embrace the whole universe of opportunity. As we said, there are plenty of opportunities beyond just individual stocks as well. There's plenty of ETFs that give you global access to high growth companies, and understand valuations. Like, valuations fluctuate. Just because they're high PE at the moment doesn't necessarily mean they're going to continue that way.
Yeah, I mean, growth companies will often trade at high PEs and grow into their PEs. Like,
Amazon's a classic.
Yeah, there was this trope for years that Amazon always trades at a PE of 60, and they just kept growing, and then they would keep trading at a high valuation. If I think about the Aussie tech companies that I own, companies like Catapult and WiseTech, they're not just competing in Australia. They are global tech companies that just happen to have been started in Australia and listed in Australia. And so to draw it right back to the question, like, that's how I approach it. It's like, be country agnostic and just look at every opportunity against each other.
Yeah.
Don't give Australian companies more forgiveness on high valuations because they're Australian or anything like that. Just apples to apples comparison. What do you have to pay for a dollar of earnings today? How much are they going to grow into the future? What problems are they solving? How can they reinvest that money? It's just like, for me, what country they exist in shouldn't play a role.
And I also think his second part of his question, how should we trim or sell positions? If your thesis hasn't broken just because it's trading at a high multiple, doesn't mean you automatically need to be selling and trimming.
No, yeah.
Nice. Well, thank you so much for your question, Arjun. We really appreciate it. As I said, leave us a voice note, or you can write to us at equitymates.com/contact if you would like to ask a question. We're going to take a quick break, and on the other side, we are going to explain the proposed superannuation tax that has come through from the Labor government here in Australia. We'll be right back. There's been a lot of noise about the government's proposed superannuation tax. In this segment, we're going to explain everything that you need to know, and we're going to be neutral about it the whole way.
Bryce is going to bite his tongue. So let's start with what is the proposed tax change. The Australian government has proposed a change known as Division 296. You're never going to need to know that, so don't even worry about it.
It does pop up a lot, though. People say, Div 296.
Yeah.
When you see it, that's what they're talking about.
Yeah, and it's actually, it's going to be retrospective. It's going to apply from the 1st of July 2025.
Yeah.
Now, what this tax proposes to do is introduce an additional 15% tax on earnings for individuals with total superannuation balances exceeding $3 million. So for the $3 million and $1 and up, rather than paying a 15% tax, you'll be paying a 30% tax.
Yeah.
But here's the kicker, and here's one of the reasons why it's been controversial. It will be a tax on earnings, both realised and unrealised. So if you own the ASX 200 ETF, traditionally you would have to sell that ETF and then you'd be taxed on the gains.
Yep.
But under this proposal, you would be taxed if the ASX 200 ETF goes up in value, even if you don't sell it.
You wouldn't want Bitcoin in there. You wouldn't want Bitcoin in there.
Let's get to that.
Let's get to that. As you said, it's going to be retrospective because it currently isn't. It hasn't passed both houses. It's passed the House of Representatives, but it's currently being debated in the Senate.
Yes.
But as you said, Ren, if it does pass, it will be effective as of 1st of July 2025. And there are three reasons that it's being debated at the moment, three controversial reasons. They are the lack of indexation, taxing unrealised gains, and funding impacts, particularly through VC. So let's start with the indexation.
Yeah, now this is an important one because a lot of people are probably thinking about the superannuation tax and thinking, who cares, doesn't affect me.
Think again.
And as of today, you are correct. So as the government have pointed out, this change will affect approximately 80,000 individuals, which is approximately 0.5% of superannuation account holders. literally targeting the 1%, less than the 1%.
Less than 1%, yeah.
But it's not indexed. So what it means is that 3 million threshold will remain at 3 million forevermore unless a future government passes a law to change it, rather than it being indexed to inflation. So, if inflation's up 4%, that cap rises 4% and then it's reset there. And this is going to matter because $3 million might seem like a lot in superannuation today, but we know that inflation devalues a dollar over time. And, $1 million isn't what it used to be, I guess is the shorthand way of saying it. So I just had a look at a compound interest calculator and assumed, let's say someone over their lifetime of earnings, their average salary is $100,000 a year, which would mean at a 12% superannuation guarantee, that's $12,000 a year going into super, or $1,000 a month. So $1,000 a month for 40 years of your working life at an average return of 8% per annum gets you to $3.13 million.
Yeah.
I think that's a pretty conservative assumption.
This is going to affect a large proportion of us.
Yes,
for sure.
yes.
For sure. And this is why we should be paying attention to it. I did the maths on our super balances and whatnot, and 100%, we're going to be this is something that a lot of, even people starting work under 18 now, they're definitely going to. They're definitely going to. So
because if you think about I think the average, not the median, but the average salary in Australia today is a scratch over 90,000. If you think about inflation in 20 years' time, the average salary and the median salary probably will be into six figures, and that means your super 12% super guarantee is going to be more, but the super guarantee could go up from 12% as well.
Exactly.
And then we always talk about it that with dividends reinvested, the average return of the Australian stock market over 125 years hasn't been 8%, it's been 13%.
Yeah.
And it all adds up to the fact that this is going to affect a lot more people than we think about today.
Yeah.
So that's the first reason for criticism. It's today it might just target the top 1%, but over time it will hit most people.
Yeah.
That's number one. Number two is taxing unrealized gains. And this is where Bryce gets hot.
Critics argue that...
critics argue.
Well, firstly, let's just rewind. Taxing unrealized gains, as you said, Ren, is taxing gains on investments without even having to sell them. And critics do argue that taxing unrealized gains is unprecedented in Australia's tax system. It could lead to liquidity issues because if you're getting taxed on gains, you're going to need some sort of cash to actually pay that tax. And that's going to lead to, I guess, having to sell assets to pay that tax. So this does happen in other countries around the world, but it's a major change here in Australia.
Yeah. I mean,
major change.
The principle of taxation really up until this point has been you get taxed when you have cash.
Yeah.
When you sell an asset or when you get paid a salary or when you get paid a dividend or when you get paid rental income, they take some of that cash flow because that's that's the simplest way to tax and it's the less burdensome on the taxpayer. Taxing unrealized gains as a principle is going to be a new principle for Australia. And it's a principle that a lot of people are not excited about.
Yeah.
And I want to be fair, there are a few instances in Australia where we tax the value of an investment before that investment is sold. And the classic examples are land taxes for investment properties and council rates to an extent. But the quantum of tax here is different.
Yeah, far different.
And just very simply, let's say you make your super balance is $3 million and you make then $100,000 gain on your investments. You tax it at a 30% rate, so you've got to come up with $30,000 in cash. And that might be in your super environment, so you have to sell something in your super, or you got to top up your super to have cash in there to pay it. It's an unusual principle. And to be fair, even if they didn't raise the tax rate and it was they just kept it at 15%, but they were taxing unrealized gains, people would be pretty hot about that as well.
100%.
Yeah.
You don't have to sell your investment property every year to fund your land tax.
Yes.
It's this is a quantum leap in terms of a tax strategy. And you're getting taxed on, Anyway, that's something controversial that's getting debated. The third is the impact on funding, particularly VC companies, because the superannuation industry, what is it, a multi-trillion-dollar industry here in Australia, are huge funders of VC.
Okay, so let's just, the classic example of why this is bad for VC is a lot of people would have invested in Canva through their self-managed super fund.
Yeah.
But think about the tax burden if you'd invested in Canva through your self-managed super fund, and then as Canva shoots the lights out and goes from a multi-million-dollar company to a $40 billion company, those shares that you held in your self-managed super fund, every year, whatever that gain is year on year, you have to come up with 30% of the value of that gain in cash to pay tax.
A lot of SMSFs also use their super fund, like mums and dads or whatever, use their super fund to do startup investments as well. It's not just VCs.
So that's the policy. We're on an investing show to talk about, personal investing and how we're navigating this world. So how do we think about it as investors?
Whoa.
And this is where you can get on your high horse if you want.
No. Look, so I think if we start with the tax rate, the 30%, proposed tax does bring it in line with other sort of tax advantaged vehicles. So there's things like the company tax rate, which is 30%. You can use things like investment or education bonds, which limit your the tax to 30% as well. So there are other ways that you can limit your tax, and this kind of just brings it in line with that. So from that point of view, you're not worse off, but you're not better off if you were to stay in super. But I think it's going to fundamentally shift how people invest through their super fund. I would argue that you're going to see a lot more risk investments outside of super. I personally wouldn't be making long-term, high capital growth investments through my super fund.
Yeah. Which I think isn't bad.
So, I don't think that's bad.
So I said we're not going to be political, but I'm going to just close with a small political thought, which is, the superannuation system has been the best system, and we are the envy of the world. And there are literally the Milken conference in America earlier this year, they were talking about how they could replicate the success of Australia's super system. Let's never degrade the great thing we have built. But it also wasn't meant to be a tax haven. And I think there is an element of reasonableness to say at some point when you've got enough wealth in your super to fund your retirement, we should then bring tax rates in line with other vehicles that rich people use to minimize their tax, such as corporate structures or investment bonds, like you said earlier. And so I think bringing it to 30% is reasonable over a certain threshold. I think not indexing that threshold is unreasonable, and I think taxing unrealized...
I think it's a sneaky from the government, though.
Yeah.
They're just...
Yeah, because then all of a sudden it's no longer just targeting the wealthy, it's then just a way to wedge it in and then expand it over time. And I also think this tax on unrealised gains from a principal point of view is something that's never been seen before. And we should be wary that if it starts in super and moves outside of super.
Definitely.
And so honestly, I'm confused why there isn't a compromise position here. I don't understand how... there isn't a debate being engaged in, and rather it's just this is the policy and we're doing it.
Let's pass it, yeah.
Because I think there's some pretty reasonable questions that can be answered and things can be adjusted while still not losing the principle that at some point people have enough in their super to fund their retirement, and then then the tax advantage should level out. Yeah. Well, it doesn't disappear completely because 30% is still better than the 45% marginal tax rate. So there is still a tax advantage, but it's not an additional advantage over holding assets in a company or an investment bond or something like that. I just don't understand why there isn't a middle ground.
Yeah. Well, I mean, it's still being played out. Hopefully the debate continues in the Senate.
Well, no, what's happening in the Senate is that there are questions on both sides, because what the Greens want is to reduce it to 2 million.
Yeah. Anyway, we'll continue to watch it.
Honestly, 2 million with indexation would probably be better off over the long term than 3 million without indexation.
Still no unrealised gains, though. Surely get rid of that.
Surely. Anyway,
we're going to watch it closely.
Would you do anything differently in your super today?
I've thought about that. It's the maths show that we're going to get there.
Yeah.
We're going to get there. And so it's as I said, longer term, high capital growth investments, I probably would genuinely reconsider.
Like what though?
Like Bitcoin.
Okay.
I don't know. Maybe like also illiquid
But
stuff.
you don't own
like,
you don't own Bitcoin in your super now.
No, but
So I'm saying, like, for you personally, are you going to do anything different?
right now, I'd honestly need to speak to someone professional, but no,
Okay.
I don't think so.
Yeah.
I don't have a self-managed super fund right now.
It will affect all super funds.
I know, but I think when I get to a point of being like, okay, should I buy a property through super or should I buy Bitcoin rather than just being, at the moment, I've just got.
Okay.
Do you know what I mean?
So to just draw a line under that, today you're not going to do anything different. Yeah.
no.
I think for me, that's the same as well. Like, if you're someone like Bryce and I, who's early in their superannuation journey, you know, below $1 million, like, $3 million in your super is a good problem to have.
Yeah.
Let's
absolutely.
get close to 3 million
100%.
before we start worrying about adjusting our strategies.
Yeah.
You know, if you're getting close to 3 million, I would then start thinking about the incremental value of additional contributions. If, like, you're then you're getting a tax benefit, but you're putting it into an environment where you start going to get.
You're probably not even getting concessional if you're at 3 million at that point.
Yeah. So, but for me, it's like, let's not throw the baby out with the bathwater. If you're young, if you're early in your career, if you're not close to 3 million, let's try and get there still and then figure out the problems once we get there.
Yeah. Well, we're going to keep watching it. Make sure you're following wherever you are listening or watching today so you don't miss another episode here at Equity Mates, and subscribe to our daily newsletter so you keep up to date with all of the news every day, 6 a.m. straight to your inbox. We would really appreciate it if you could leave a rating and a review in your podcast app or a comment below in the YouTube section, like the video, whatever you do to engage. We really appreciate it.
Here's what, if you're watching on YouTube, debate this super tax in the YouTube comments because that'll boost this video. So let us know your feelings. The stronger feelings, the better. Jump onto YouTube and let fly.
Love it. We'll leave it there. Thanks for listening. We'll be back next episode.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.